This podcast is brought to you by AppFolio Investment Management. In a recent study, AppFolio Investment Management customers reported up to 70% growth in their total EUM over a one-year period. How? They were able to cut fundraising time down by 50%, automate waterfall distributions, and impress investors with an online investor portal. Learn why thousands of real estate investment managers are choosing AppFolio at appfolioinvestmentmanagement.com.
Welcome to WMRE's Common Area Podcast. This podcast is brought to you by the award-winning editorial staff at WMRE. Let's jump right into this week's podcast.
Hello and welcome to the Common Area with your host, David Bodamer. David, how are you?
Plugging away. I think from our last episode, I mentioned that I now looking and house hunting in this crazy or apartment hunting in this very competitive New York environment. So no real updates there, but just that's like my second job right now.
Yeah, living the dream. Oh my goodness. Yeah, I don't envy you. Good luck with that. Continued. I know that you have another guest on the show today. Who'd you bring on?
So this week we have William Maher, who is the Director of Strategy and Research at RCLCO Fund Advisors. He's also a member of ULI Washington and was a participant, a respondent in the ULI Spring 2022 Real Estate Economic Forecast. So William, welcome to the podcast.
Oh, thank you. Great to be here.
So before we dive into some of the discussion of the survey, if you just wanted to take a minute to talk about yourself and RCLCO, that'd be great.
Right. Yeah. We pronounce it RCLCO. It's kind of it's the initials of Robert Charles Lesser and Company. And interestingly, he was one of the first real estate economists to come up with the idea of market analysis for real estate back in the 60s. And so RCLCO remains kind of at the forefront of doing market analysis for all kinds of properties, including residential and commercial. The group I'm with is called RCLCO Fund Advisors, and it's a part of RCLCO, but we specialize in consulting to large institutions, particularly pension funds, both U.S. and domestic, so on their real estate strategy and their implementation. I'm the head of strategy research. We track markets around the world and try to recommend the best investments for our clients, all of whom are very large, typically over 100 billion in assets, major institutions and pension funds.
So that definitely gives you some pretty good visibility into what a lot of big players are doing in the market at any given time.
Definitely. We're their advisor on real estate, and so we have to take into account not only the real estate investments, but everything else going on, including value of their stocks and other sort of metrics that they look at.
And then, so you're one of the, I forget how many exactly, but I think there's probably a couple dozen at least organizations and economists that participate in this broader ULI real estate economic forecast. Is that correct?
Yeah, it's done twice a year, and the last one was done earlier this year. Had 47 respondents from 36 different firms, so pretty wide representation from the real estate industry.
And any kind of any high level takeaways from this report in terms of just what the expectations are for the market?
And in fact, I wrote an article for Urban Land, the ULI's monthly publication about it. So I can give you the highlights pretty quickly.
Yeah, and we can also throw a link to that article on our show notes, so we'll make sure to do that.
Okay. So a couple things were a little bit of surprise. First of all, the survey was done in March and April, so things were pretty good there. I don't think there was much concern about Ukraine, about energy prices. So I think people were a little more optimistic at that point, and it turns out in retrospect, definitely more optimistic. But in spite of that, the group that responded did point out that they thought that interest rates would be up compared to the prior survey, and that economic growth would slow a little bit. Now that's the backdrop. Now, but to despite that, real estate performance, including rental rates, occupancy rates, returns, all kind of went up a bit from the prior survey that was 6 months earlier. So it was generally positive. And I think that was a result of how strong the real estate market had been between, let's say, fall of 2021 and early spring of 2022. Pretty much every property type was recovering from the COVID downturn, and some of them, including industrial and apartments, had moved well beyond where they were pre-COVID. So generally pretty positive on the real estate side, a little bit negative on the economy side.
And overall, just the sense that even with some of the headwinds that may be coming, that the fundamentals are strong enough within all these different property types for real estate to weather what's coming.
Yes, but at that point, coming.
Yeah, right. At that point, it wasn't maybe as I guess that what you're sort of saying here is that this was done a couple months ago, and maybe now the forecast is a little bit darker than it was when this was done.
Exactly. I mean, just a few months ago, the median forecast for 2022 GDP was 3.2%. Who knows what that will be now, but it's definitely a lot lower than that. So that would temper probably people's opinions. But again, that's where we were, and it was leading to strong real estate results.
And so this is done twice a year. So the next time would be October. So that's when we would see any adjustments in some of those expectations.
That's correct.
I guess, what's interesting is like being being thrown into this multifamily rental market in New York City right now does not seem like a recession at all.
No, I mean, it's amazing how the major markets, which got hit the hardest, are now so strong. And despite the fact that people aren't going back to work, the occupancy rate for office buildings is 40 or 50% probably. And so people are working from home, but they realize, I guess they'd rather be in New York City than in wherever they were staying at their vacation homes or friends' homes.
Right. Yeah. I mean, just from I could tell you from our neighborhood, it really has just changed into a more of like a work from home neighborhood within Brooklyn now, where a lot of the main commercial drag there's just a lot more lunch places. There's a lot more cafes. There's a lot more like that kind of like daytime business, because there's a bigger daytime crowd here than there was sort of pre-pandemic. And yeah, it just seems like even though it's only 30-40 minute subway ride back to the office, most people are here at least part of the week.
And I'm sure that it's not so great on 6th Avenue and Midtown Manhattan. It's probably the opposite.
Right. But that's just one sort of microcosm that I think we've been all wrestling with what the future of office looks like. But, it does seem like aside from that kind of question, which is continuing to play out, industrial, multifamily, even now retail seem really good.
Well, I'll sort of agree with you on industrial and multifamily. One of the things going on with industrial is that the vacancy rate is at an all-time low, and rent growth has been at record highs. Returns for the past year for industrial were about 45%, which is just a record for any one property type, and it continues to be really strong. And I think that's probably, if there is a downturn, it's the sector that will do the best, even if there is a recession or a slowdown. And that showed up in the survey results. It was the lowest vacancy, the best rent growth, the best returns for industrial, and it's hard to see anything changing that, because there isn't all that much being built. There's a fair amount being built, but I don't see overbuilding in any shape or form. For apartments, same story. Record low vacancy rates. Rents are rising very rapidly across the country, and I think that it's the benefit of what many people believe is an overall housing shortage. We've just built far too little housing since the global financial crisis, when housing pretty much shut down, there's a, depending on who you talk to, a 2 to 4 million unit deficit for the country. And right now that's sort of playing out the most in, I'd say, Sunbelt, single family homes, and urban apartments. Those are the two places where it's the tightest. And retail, certainly neighborhood retail, grocer anchored, that's a necessity, doing well. We're all complaining about rising prices at the supermarket. I think there's a little more profit being made at supermarkets, so very strong there. But the fashion retail, the discretionary retail, still not doing great. So some malls continue to struggle. Some are fine, some of the best ones, but there's a lot of B quality malls that are questionable in terms of their long-term survivability.
Got it. So there's still some shakeout to come there, but it does seem like across the board, again with the caveat of this being a couple months ago, the forecast for every sector is positive returns. The degree of how much it varies. I mean, I think industrial. The forecast is 20% for 2022, 12% so you're looking at double-digit returns still were projected for this year or next year, still on industrial, pretty big for apartment, but then more like 5% range, 5-6% range for office and retail.
Yes, that's right. Office surprised me. I mean, it's all income. There's no appreciation. I think that's at risk, that office forecast. The rent growth, assuming there was decent job growth and decent GDP growth, was only 0.1% for 2022. It went up to 2% for 2023. But I think if there is slowing job growth and kind of slowing economy, I think the office space is the most at risk because the vacancy rate is so high,
right.
Much higher than normal. And some landlords can sit and wait for a tenant to show up, but I think they'll be discounting rents, if this goes on for longer.
And then the other property type, which we haven't touched on, which there is some coverage of in the report, is the hotel sector.
Yeah, hotels have actually surprised on the upside, I think. They're still seeing a little less than normal business demand, but they've been making up with leisure demand. There was all this pent up demand for leisure, so room rates are up, occupancy is close to normal, and I think hotels are feeling pretty good right now.
And in terms of like different kinds of investor groups, REITs versus pensions versus private equity, or all the other sources of capital out there, is there any sense that different types of investors are responding differently to current market conditions?
So pension funds move very slowly. They're one of the bigger groups that invest in real estate. They were underallocated to real estate prior to this stock market correction, and now they're right about at their allocation. Broadly speaking, it varies. The ones we deal with are pretty close to their allocation. So, but they still want to invest in real estate for the long run. They view it as a good asset class, low correlation with other asset classes, and they're continuing to selectively invest in new strategies. At the same time, they're slowly trying to sell their core properties, the ones that are fully leased up, really don't have much more appreciation, but they're not selling at any price. And if there is sort of disruption in the market, which we may get to, there seems to be a little bit starting right now, they're willing to sit and hold. So they're going to be patient, but they still are pro real estate, I would say, at the margin. The private buyers typically rely on as much leverage as possible.
Right.
And they're the ones that are, the leverage doesn't make sense now. It's generally above income levels for a lot of property types. So I think they're going to be out of the market. The one wild card that we hadn't seen, say, a decade ago is what are called non-traded REITs, which are groups like, Blackstone has one, Starwood has one. There's 10 or so, and they still are raising a lot of money. They use moderate leverage, sort of 40 to 50%, but the money's coming in rapidly because they've done well, and it's sort of stock markets and until now, stock markets and bond markets have felt a little overvalued. So they've been raising a lot of money, producing good returns, and I think Starwood, we're talking about like $50 to $100 billion among that group that didn't exist. So that's new money. And once the money's raised, it pretty much has to be invested because it's sitting in cash. It's producing little or no income. So there's sort of a fuse in terms of getting that money out. So that's been a sort of a boost to the market that wasn't there prior.
Yeah, that's interesting. I think from what I remember seeing, that non-traded REITs may have had a record last year, and they had a huge first quarter this year, so they're still raking in a ton of capital. Right.
So, yeah, and then we really haven't seen international investors. It's hard for them to travel. They will eventually come back when this whole COVID thing sort of dies down, but. I think the market's been, it was record transaction volume, 800 and something billion dollars last year, highest number ever, without really much international investing.
And I assume that they're also affected by just the relative strength of the dollar now, and how that makes their investments pencil out.
Yeah, absolutely.
Yeah, and in terms of like just the overall, like the current deal market, somebody told me yesterday, I think, that there's this buyers want yesterday's prices, but sellers want tomorrow's prices, or maybe it was vice versa. Sellers want yesterday's prices, buyers want tomorrow's prices, and so that's kind of we have like a bit of a bid ask gap like that needs to be worked out.
Yeah, it's hard to put numbers on it because it's not a transaction, but we talk to a lot of brokers and estimate there's sort of a 5 to 10% bid-ask gap, and that's would be, if you split the difference, of 7.5% decline in where people thought prices were a few months ago. So which are up from where they were 6 months ago. So maybe we're flat from 6 months ago, but there's definitely I think it's really been related to two things. The interest rates have definitely affected some buyers, and then concerns about the economy and demand are affecting others.
Do you have any long-term expectations around inflation?
Yes, as far as the survey is concerned, economists expected 6% inflation in 2022, but then leveling off to 3% in 2023 and 2.5% in 2024. That seems a little bit optimistic. The 5-year TIPS bond implies about a 3% rise over the next 5 years, and actually 3.5%, I should say. So the economists are a little bit optimistic, but again, that was prior to the May inflation report, which was higher than a lot of people thought it would be. Everybody thought it would start to trend down, and it jumped up a little bit. So long-term inflation, I would think we're going to be around 3%, and that probably needs needs the Federal Reserve to kind of fight this spike in inflation and successfully fight it, which is a little bit of a risk right now.
Right. Are there any other kind of high points from the report that we have not touched on yet?
Well, the Treasury rate was I won't call it a miss, but it wasn't. It's not looking too good right now.
Okay.
The survey said that the 2022 rate would be 2.7%, and as I looked this morning, it was 3.4%. So,
oh wow, yeah,
that's off by a lot. And then the other area is housing. And expected continuing growth in new home starts, and the number was pretty high. Again, the mortgage rate is the 30-year mortgage rate is over 6% now. It was probably in the 4s back then. So I think there's got to be a slowdown in housing demand. And yeah, the forecast So single family housing starts were about 1.1 million last year. Forecast was for 1.2 million this year, 1.25, and then down to 1.1 in the prior 2 years. And I think the demand's there, but I don't think the ability to pay is there, and particularly at the middle income levels with mortgage rates being up so much. And that's sort of we did a calculation that between mortgage rate increase and price increase, the monthly payment's up about 50% for the median buyer, which is a lot most people can't handle that.
And does that starts figure though also include the single family that are being built straight for rental?
That's a good question. I think it does not.
It doesn't. Okay, so that's pure just single family residential for sale market.
Right, and that's an area that the survey doesn't cover, is the single family for rent.
Right,
and how many new communities are being built. And I have to say that our clients are involved in a fair amount of them. They range from sort of 100 to 250 detached small houses that are very high quality, but compete with apartments in terms of rent rates. We think that it's a good addition to affordable housing, compared to building McMansions or $100 million houses. But there is a lot of controversy about that. We understand.
Yeah, I think it's just we've definitely talked about it on previous episodes, and we have a survey around that. I think it's always just been hard to get a full handle of like what percent of the single family housing market is still just residential for sale versus how much of an I think there was a time where people were like, well, this is just a really small part of the market. It's not even large enough to have much of an impact on the for sale market. But now it does seem like it's grown to the point where it may have, be putting some pressure on there. But it's
I guess the assumption is that the builders would sell these, at moderate price, 300, 400,000. But if they were going to sell it, they would build a higher end product to get more profit. So it's hard to get that comparison right in terms of what you're getting and what you're giving up.
Well, I think I've taken up a good chunk of your time here, so I appreciate you, going with all of my kind of random tangents on these questions.
My pleasure. Glad to do it.
And once again, it's William Maher from RCLCO. Sorry about the company name earlier. And we will, in our show notes, have a couple of links for you to follow up. But if you want to say anything else before we're out.
No, thank you. I'm glad. I'm very glad to be part of this survey each time, and I think it's a good addition for the real estate industry.
And I think it was a great addition to this podcast. David, thank you so much for having William on. William, of course, thank you for your time. You were very generous with it. And our last thank you goes to you, listening audience. Thank you so much for tuning in and listening to the Common Area Podcast with David Bodamer. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when David comes out with a new podcast, it'll show up directly on your listening device. And we humbly ask you to share this podcast, rate it, and leave a review, because this actually helps others find the show. Again, thanks for listening today. For everyone at WMRE, this is Eric Johnson inviting you back in 2 weeks for all the stories that matter to you. We'll talk to you soon.
Thank you for listening to the Common Area Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of WMRE or Informa. The content has been made available for informational and educational purposes only.